The quiet Fed is ready to speak. The Federal Reserve's blackout period begins 2 Fridays before a rate decision, and that blackout in this cycle coincided with the start of the Silicon Valley Bank shutdown and the start of a complete reversal of the Fed's expectations. All the while, the Fed maintained their silence. Shh. On the Wednesday preceding that Friday, the 2-year yield reached a high yield of 5.085%. This occurred after Fed Chair Powell's testimony on Capitol Hill on Tuesday and Wednesday, where he stated, "Nothing about the data suggests we have tightened too much," a hawkish comment. However, Powell also mentioned, "We are carefully looking for lags in monetary policy coming into play." That comment was a bit of a foreshadow of what was to come, but I am not sure the Fed chair anticipated what actually happened. Regarding monetary policy, he added, "As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time." Those words, increasing the pace of rate hikes, had the markets worried that 50 basis points was coming, not 25 basis points. On that same Wednesday of the Fed chair's testimony, the terminal rate for Fed funds was at 5.69%, which, considering the 25 basis point target range, equates to a high terminal rate of 5.75%. That's compared to 4.75% currently, so 100 basis points higher from the current levels. Meanwhile, the January 2024 Fed futures contract were implying a rate of 5.5%. So although they saw rates moving up 100 basis points, the market also saw that toward the end of the year, because of a slower growth, that the Fed would be forced to ease rates by 25 basis points at that time. Meanwhile, the Fed official comments before the blackout period leaned toward the risk of inflation. We heard Fed's Daily say that if the inflation data is hot, we would adjust the rate path higher and longer. Fed's Barkin stated, if inflation persists, we can raise rates further than forecast. The Fed's semi-annual monetary policy report noted that ongoing increases in the Fed funds rates are necessary. And finally, Fed's Bostic commented, the Fed may have to do more given the high inflation. The significant data that the Fed chair spoke of included the employment report on Friday after his testimony. That came in mixed but solid, with 311,000 jobs added versus the expected 205,000. Meanwhile, the unemployment rate did increase to 3.6% from 3.4%, and earnings moderated a bit to 0.2%, but both those measures were still showing strong growth and increased inflation pressure. Last week, U.S. CPI data showed a 0.54% increase for the headline and a 0.5% increase for the ex-food and energy. Year-on-year figures for the core and for the headline number came in at 5.5% and 6% respectively, still well above the 2% target from the Fed. It's probably safe to say that without the banking crisis events that occurred, it's likely the terminal rate discussion would still revolve around 5.75% and possibly even 6%. However, we know Silicon Valley Bank filed for Chapter 11. We know that Signature Bank was shuttered by the FDIC. We know that Credit Suisse faced extreme pressure leading to a merger over the weekend with UBS. In the U.S., the focus shifted from the other banks, Silicon Valley and Signature Bank, to First Republic as it became the center of the banking concerns, prompting other financial institutions in the U.S. to come to its rescue by depositing $30 billion in an attempt to avert a run on the bank. Nevertheless, the shares of First Republic, which rallied up to $40 on Thursday from about $17.90 on Wednesday, closed near $23 on Friday. The market now anticipates a 75 basis point chance of a 25 basis point hike for the March 22 Fed meeting, with a 25 expecting no change. The market now sees the terminal rate down from 5.75 to 5.25%, which is unchanged from the dot plot in December, but 50 basis points lower than last week's pre-crisis highs. Meanwhile, that January 2024 Fed funds contract now estimates the average Fed funds rate for that month at 3.83%. That's down from that 5.5% rate just a week ago. This represents a significant change and expectations that the Fed will be slashing rates later in the year. The 2-year yield also reflected this idea, as it dropped from 5.085% to 3.848%, a huge drop in a short period of time. The 10-year yield fell from 4.089% to 3.436%, a 65 basis point drop, and that widened out the 2-10-year spread to a modest minus 41 pips now, but it was minus 108 pips just the week before. All of this occurred without any comments, without any talk from Fed officials. So this silence actually makes Wednesday's decision even more uncertain for the markets. The markets went from fast break to the upside in rates to fast break to the downside in rates. Although the Fed has been quiet, the Wall Street Journal's Tim Rose, thought to be a mouthpiece for the Fed, suggested that a 25 basis point is likely in order to avert a market melt-up. Can you believe that? With the decision depending on market response in coming days, likely as a result of the banking industry and how the markets react to the liquidity situations in the banks. Tim Rose also echoed ECB President Lagarde's sentiment, stating that the Fed has the tools to address financial stability issues while focusing on restoring price stability. Recall, last week the ECB, despite the banking crisis in Europe and the U.S., proceeded with a 50 basis point hike, and President Lagarde stated that they had the tools to avert a financial crisis, but inflation was their main focus. So it is uncertain whether the ECB's Lagarde and Fed chair shared conversations, but if the Fed chair wants to, they can follow the blueprint from the ECB. That is, state that banks are in good shape, you don't have to worry about them, that they have different tools for financial stability and for monetary policy, that inflation is still a concern, hence the need to continue to raise rates by 25 basis points, that they will back off promises for future rate hikes to let's see what happens going forward, and that they will be more data dependent. Now, if so, the potential risks lie in rates having dropped too far too quickly. Higher rates might lead to a tech-heavy NASDAQ, which rose over 4.4% last week, to take back some of those gains. Then the Fed will have to wait and see, but at least they will be able to talk. So what will that do to the Forex market? Let's take a look at some of the technicals that are driving the Forex market, because they are going to be important as the market works through these landmines.